The way you get rich as an employee versus an employer isn't very different, but there's one factor that so many people are overlooking, which is keeping them broke. Take a look. When you go and work at a company, what you're doing is you are going and spending your time at this company, and in exchange for you putting your time in this company, you are getting paid with a paycheck. Now, when you get paid, you are happy. When you are the employer, it works kind of the same way. You're putting your time into the company. Maybe you created this company, and in exchange for putting your time into this company, you're also getting paid with a paycheck. But you as the employer also have the ability to get access to these profits. If you're making something like $50,000 as an employee, then the company is going to have to generate an additional $50,000 on top of that in profit to justify having you as an employee, and the person who gets the ownership of those profits is the owner of the company. So now the owner, the employer who's working in the company, they're happy not just because of the salary, but because they're getting these profits. So now what does this mean for you? Well, you as the employee, you want to do exactly what your employer is doing. Now, if you don't own this company, or if you don't have equity in this company, what do? Well, you do the same thing, just in a different asset. Now, you take some of this money that you're generating, instead of putting it back into this company, you're going to put it into this asset. And we'll talk about what that means in just a second. But now what you're going to do is you're going to take this money that you generated and you want to put it into these assets. That way you can get the profits from these assets. Because for the employer, this person's assets is this company. So now when they generate money, you would hope that they would take this money and put it back into the company, or at least a piece of it. That way they can grow the value of this asset bigger and make this company more valuable. And what you want to do is the exact same thing. You're making money from the company, you use it to buy these assets. As this asset makes you money, you can use it to buy you more assets. That way your asset can become more valuable. Now, what can these assets be? These assets can be companies on the stock market. These assets can be startups that you invest in. These assets can be real estate. This could be your own business. There's really no limit to what these assets can be, but the whole point is now you want to take your money and put it into this because your employer is doing that with this company. Now, what a lot of people assume is, oh my God, I'm generating $100,000 for the company, but I'm only making $50,000. See, a smart employer, not every employer does this, but what a smart employer will want to do is take the bulk of those profits, especially in the early stages of the company, and put it back into the company. That way the company can become more valuable. That way you can also see an increase in your salary because now you're working for a more valuable company. Your role starts to increase in the company so you can have more income potential. But you want to see this smart part if you are an employer where you're working to grow the value of this asset as well. Because if a company makes $1 million, that doesn't mean that the employer is making $1 million. That means the company made $1 million. Maybe the employer made $50,000 in salary out of the $1 million salary, but the key is now you want to work to grow the value of the asset. And the same thing applies for you. The mistake that so many people end up making is they get stuck in this system right here where they say, okay, I'm going to exchange my time in exchange for dollars because I'm going to work in this company. Then you get angry because you say, oh my God, I'm making $50,000, but my company's making $100,000. This is stupid. And now with that anger, you take this money that you're making and now you go to the Gucci store and now you spend your money. Now your money is going into somebody else's asset because the Gucci store is somebody else's asset. When you go to the BMW store, that's somebody else's asset. When you go to the Apple store, that's somebody else's asset. You're going and you're spending money here, making somebody else's asset more valuable. Because now you're upset with the way this economic system works. You're upset that somebody else is making money off of your time. You're upset that you're not making enough money. You're upset that your boss is making more money than you. When instead, what you should be doing now is working to see how you can increase your value here. If this is something that you enjoy, if you hate your job, go find a different career. You want to do something that you feel passionate about. It doesn't make sense to live a life where you just want to quit your job. Find something that you actually care about and find a company that you enjoy working at. That way you want to work hard. That way you can increase the value that you're getting. But now instead of going out and spending all of your money in anger, take this money that you're generating, or at least a piece of this money, to start doing exactly what your employer is doing. Use this to start buying these assets for yourself. That way you can start creating your own income and start building your own wealth. Because the reality is, if you are in America, everybody in America should be a business owner, period. This does not mean you need to go out and operate a company. This does not mean you need to go out and manage a company. This does not mean you need to go out and start a company. but you have to at least own a piece of the profits. Again, one of the simplest and most accessible ways to do that is by putting your money into the stock market. You could go out and start investing in rental properties. Now you're starting a business there as well. But the key is you need to start putting your money to work. That's how you build wealth in a capitalist system. I wish we would have learned that basic concept when we were in school. We go through all the schooling to go out and get a job. We work in the capitalist system, but most people have absolutely no idea what it means to work in a capitalist system. So then what ends up happening, people end up here, then instead of being happy about this income, they end up being very angry about this system because they don't understand how the way this system works. Then they hate this system because we never learn how this system works. In a capitalist system, there are two ways that you can make money. You can make money from your labor, or you can make money from your capital. When you go to work, you're making money from your labor. When your boss goes to work and they get that paycheck, they're making money from the labor. But the way that real wealth is built through a capitalist system is by investing your capital. When your boss, if they own the company, when they reinvest their money into the company or they reinvest their profits back into the company, now they're putting their capital to work to own the value, the equity, the profits in this asset. The same thing can apply to you. When now you take some of your money, you're taking your capital and you use it to buy this asset. Now you're putting your capital to work. Now you get your piece of the profits. Now you get your piece of the equity. Now you get a piece of the valuation of this. Because when your stocks go up in value, you get to benefit from the valuation. When your stocks pay out bigger dividends, you get your piece of the profits. When you start to make more money here from your rental properties, you get your piece of the profits. Here, it's from the effort and the money that's produced by the company that goes to the owners. When you don't own the company, you have to do the exact same thing, not in your own company, but somewhere else. That way you can benefit from the way that this economic system works. Now, before we go any deeper, I do want to let you know that this is one of the concepts that we highlight in this ebook, How to Build Wealth as an Investor, that you can read for free. My team at Briefs Media put this together. In this ebook, we start with the basics of how do you build the mindset of an investor, to how do you save your first couple $1,000s, to how do you start investing, to the different ways that you can invest your money, to how do you generate cash flow, to how do you spend your money smartly, to how do you earn your money, to how do you protect your assets. This ebook is completely free. So if you want to build your financial education and learn more about how do you invest your money smartly, you can read this ebook. I got the link for you down in the description below. Or you can go to briefs.co/ebook. There are two ways that you can get paid now as an investor. Now, this same applies whether you are the employer or whether you are investing your money into different assets. And the way that you get paid are through either cash flow or through value growth, meaning the increase in the value of investments, also known as appreciation. Starting with cash flow, the way it works if you own the company that you're working at is you work in the company, you get a salary. That's not your cash flow. That's your salary as an employee in the company. If you start a company and you are the CEO of a company, you get paid a salary for being the CEO. Now, if this company that you own, that you're working in, makes a profit, maybe you generate $1 million a year in revenue. You have $500,000 a year in expenses. That means you have $500,000 sitting in the bank at the end of the year. That profit is what you are entitled to as the owner, not the CEO, but the owner of the company. Now, as a smart owner, if you're starting up and you want to grow, you're going to take all or most of this money and you're going to reinvest it back into the company. That way you can grow this company bigger, faster, and stronger. But as you start to grow, maybe you're going to want to start using some of these profits for yourself or start to pull some of these profits out. So now you are entitled to those profits as the owner, and that is now your cash flow. If you don't own the company that you're working at, that's okay. You could do the same thing in other assets. How do you do that? Well, you can invest in stocks that pay out a dividend. You can invest in real estate that's paying out rental income. Now, what you're doing is you're buying a business on the stock market, or you're creating this rental property business in the real estate market. And now, if this thing that you own is putting out some cash flow, is putting money in your pocket, that's cash flow. And the key for you now as an investor is to make this as passive as possible. I have other videos on my channel that go over how to do that. But the key here is now is you don't want to be spending all of your time monitoring your investments and managing your investments, because now it's not an investment, it's a job. Your job as an investor is just to own the asset and get paid with the cash flow. You can do that in real estate by getting a property management company, and in stocks, well, you have to invest in the right things. Maybe invest in stock funds, ETFs, index funds, mutual funds that pay out dividends. That way now you don't have to actively monitor your investments all the time, but you can still generate that cash flow. Now, in this cash flow, what you're getting is you're getting your share of the profits, and they're distributed out to you without you having to sell your asset. That's one of the reasons why I love investing in cash flow personally. I don't recommend what I do to anybody, but I love investing for cash flow because I don't have to sell my assets. I can get paid just for owning the asset. And now my goal is to just stack the cash flow year after year after year, make the cash flow a little bit bigger. That way the cash flow, once that funds the lifestyle, now you are financially free. The second way you can get paid is through value growth. Now, if you are the employer of the company and you reinvest the money back into the company, now what you're trying to do is you're trying to make this company more valuable. If your company makes $1 million a year, you have $500,000 in expenses, you have $500,000 worth of profit, that means your company might be worth 10 times profits. That means your company might be worth $5 million if you generate $500,000 a year in profit. So if your company is worth $5 million, the way that you can increase the valuation is by increasing the profits. Now, if your company can make $2 million a year in revenue and you have $1 million a year in expenses, that means you have $1 million of profit. Now, if you apply that same 10 times multiple to that profit, that means now your company is worth $10 million. You become more wealthy on paper because the value of your investment, the value of your stock, the value of your company is now more valuable. Again, if you don't own the company that you're working, how do you do that? Well, you can invest in stocks, you can invest in real estate, in growing areas, in growing demand areas, in growing sectors that become more valuable. If you invest $100 into a company and the stock price doubles, well, now you just doubled your investment. Now, there is more risk here because there's a chance that your investment value will not go up. Just like with your company, there's a chance your company could go bankrupt. Well, if the value of your investment doesn't go up because of the economy, because of other things, you don't get paid until you see the value of investment go up and you sell. But this is where you have to understand what is the right investment goal for you and make sure you make investment decisions accordingly. And even when it comes to value growth, there are some investments that are going to be more risky than others. Like if you go into the stock market, you can invest into a high growth company, a company that's making $0 in profits because they're reinvesting all of their money and some by taking on debt, by taking on more investors to grow the company as big as possible, as fast as possible, because they want to grow the value of the company. That's one way to do it. Or you can invest in companies that are already established, that are already making a healthy profit. And now they're just trying to get the slow and steady growth. The slow and steady growth is less risky, but you're going to see less upside. The fast and aggressive and risky growth is more risky, but you have the potential to see more faster appreciation. And this is where, again, your goals are very important to understand. If you're willing to take on more risk, well, then you can make different investments than if you don't want to take on as much risk. And if you want cash flow, well, again, you're going to make different investing decisions than somebody here who wants to just see the fastest appreciation. Not to mention the fact that when you get cash flow, you got to pay taxes on that cash flow. If your stocks pay out a dividend, if you're getting profit distributed into your pocket, that's taxable income. Versus if you see your stock price grow from $100 a share to $500 a share, you don't pay taxes until you sell. So you just have to understand now what are the goals that you want, but the key before you get there, before you start overanalyzing your investments, is to get started and to stop thinking like a broke person, which is, oh no, I'm just making money, I might as well just go and blow all my money. You want to be smart. Understand what smart employers are doing. Smart employers are taking the money that the company makes and they want to put it back into the company. Smart employees want to do the same thing. You want to take the money that you're making and put it back into your own company. Every person in America needs to be a business owner. Period. If you want to become wealthy, you have to be a business owner. You don't have to go out and start a company. You don't have to go out and operate a company. You don't even have to go out and manage a company. But you have to own a company if you want to build wealth in a capitalist system. And this can be completely passive, but you have to start putting your money to work. Now you got to understand that investing has risks. You might see your investment lose value. If you see a recession, your investment might go down in value. If you see a market crash, your investment might go down in value. But the key is to continue investing and to continue holding on to good investments because that's where the real wealth is built in this economic system. It's not built from your salary. It doesn't matter if you are the employer or the employee. You have to put your money to work if you want to build wealth.
If you want to be an overpaid employee, there are 3 things that you have to understand. Number 1 is you have to understand the company's financials. Number 2, you have to know how to make yourself irreplaceable as an employee. And then number 3 is you got to know how to get your piece of the pie, meaning how do you get that overpaid salary now? Now, I have hired and fired multiple people at my